Hey everybody, this is Jason Matthews, your financial guru. Right now, there's a lot of chaos happening due to coronavirus. In response to that, the people who to be able to print the money, the Federal Reserve, who's the head of it, Jerome Powell, lowered interest rates twice now, an emergency lowering of rates due to this turbulent time that we're having. And the last time he lowered it to 0% interest. And I know a lot of us have questions about what does 0% interest mean to us. And I think we have an idea about it, but more importantly, oftentimes we have a misconception of what that really does mean. I think some of us might think that we're going to have a 0% mortgage and all that, but that's not going to be the case. And what I'm going to help you guys out is how did the 0% interest really mean to you? But before I get started, let's talk about a couple of things, what I mean by that. So what does 0% interest going to mean to you in your lifestyle? One thing is, and here's the downfall of it, saving or safe money, interest will drop. Right now, I'm already seeing it where your savings accounts, your fixed annuities, your CDs, your money markets, all the interest rates have dropped due to 0% interest. So what that means is that the money, if your CD is locked in for 24 months and it's about to expire, that interest rate is now going to be dropped lower than what you had previously. It's going to be the same for your annuities. Your CDs, your savings account and money markets, interest rates have already been dropped. So that's one thing you guys should look out for. Number two, and here's the issue I think a lot of us is not considering. And here's the biggest issue of them all. Pension funds going to have to take on more risk. If you understand pension funds, which is supposed to give you a guarantee for your income for the rest of your life when you retire. Right now, there's a huge shortfall in pension plans across the country. And the way that's going to happen is, I think this downturn is going to bring on something, a bigger wave than anything, which is a pension crisis that we have never seen with the aging of demographics. So we have to be aware and conscious of that. And so what I mean by pension funds going to take on more risk is we think that the money we have is guaranteed. But the issue we're going to have is this. Pension funds have a 60-40 split usually between safe money is 40% and 60% of the money is have more risk. To reach the rate of return that they need, since interest rates have dropped so low, they're going to have to take on more risk, hoping that they get a higher rate of return, which means if you have a pension fund, your money is at a high risk compared to being at a safer place for that guarantee that you actually need. Your credit card rate will stay the same. Now, oftentimes we're thinking, hey, with our credit cards are going, interest rates going to drop down because the banks are going to get zero. No. Not the current credit cards you have and with their standard rates. What that's going to do is allow the banks to get money at 0%, and they're going to be able to take advantage of the huge spread on the interest rates that they do have. Especially with the market being turbulent, they're more worried about people unable to pay their credit, so they're keeping higher risk interest so they can make sure they have a safe gap in between that for the losses that you may have from the people who are not paying their credit cards, might file for bankruptcy during these times. But also it gives them a huge advantage of that. So what I recommend for people is this. With your new credit card, shop around. See who might give you a lower interest rate now that interest rates are lower, because they might want to be able to buy or have more of your business come your way if you have really good credit. The last thing I want to say is mortgage rates might drop. We might be thinking that right now mortgage rates might drop down further than what they are. So you could possibly see mortgage rates not drop down to zero, but we can see mortgage rates go to 2 or 3%, which could be a great benefit for you. So I want to be able to look around, be able to shop around mortgage rates. Now, when you see it at that 2%, you better lock it in like that. So be prepared. Talk to your mortgage broker. Get all your stuff in order now, so when you hear about interest rates for that day or two dropped significantly, you can make that move for it. And that's a huge thing for you. And the last thing is expect your growth rate in your portfolio not to be 10 or 12%, not to be 8 or 9%, but go by what the actuary charts are for the next 20 years, which is a 6 to 6.5 rate of return. Right now, we have went back down, dropped down to 3 levels from 2020 highest point peak down to 2017 like that. I think the real expectations, if you listen to actuaries since 2008, that we should be expecting a 6 and 6.5% rate of return overall. Does that mean that we should get that every single year? Or no? Because some years we might get 15, some years we might lose 10, some years we might get 30. But what's telling us is that overall, over a 20-year period, we should expect, or even a 10-year window, we should expect a rate of return of 6.5 to 6% rate of return. We're not knocking out the ballpark. Those times are over. But 6.5 is because lower interest rates, plus with the demographics getting older and aging, they're taking the money out of stocks and buying more bonds and safe assets. We should expect a lower growth on our portfolio. With that being said, if you guys have any other questions, please email me at matthewsfinancial@gmail.com. Give me a call, 510-229-7608. Make sure you hit that subscribe button. Tell us your thoughts and comments and what topics you'd like to hear. Talk to you later.